Over the long run, REITs have performed incredibly well, earning returns even superior to the S&P 500 and tech stocks, all while paying high dividend income. But over the past few years, they've been some of the worst performers in the entire stock market, dropping by about 20%, even as they grew their cash flows by 10%. What this essentially means is that REITs are today the cheapest they've been relative to the S&P 500 since the great financial crisis and the dot-com bubble. And what happened after those two previous periods when REITs were heavily discounted? Well, they strongly recovered and significantly outperformed the S&P 500 in the following years. I'll put a chart on the screen of how they performed following the dot-com crash, and now I'll put also a chart how they performed following the great financial crisis. You'll see there that they nearly quadrupled in value in just a few years. At High Yield Landlord, we expect a repeat of that in the coming years, leading to significant REIT outperformance. Today, you still have the chance to buy high-quality REITs with low leverage, high-quality properties, and strong growth prospects at dividend yields in excess of 6%. And in today's video, I'm going to highlight two such examples. Hey, this is Yossi. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to discuss two REITs that I think most investors should consider because, again, these are high-quality REITs that we expect to provide significant upside in the coming years, and they also offer sustainable and growing 6% dividend yields. But before I get started, quick reminder, we are still running a Black Friday sale for our REIT newsletter, High Yield Landlord. If you join today, you'll get a $100 discount as well as a 2-week free trial. So you have really nothing to lose and everything to gain. You'll gain immediate access to my full portfolio, all my research, and completely risk-free for 2 weeks. If you don't like it, you can cancel, no questions asked. If you stick for the long run, you also get a $100 discount. Check out the first link in the description of this video. So the first REIT I'm going to discuss is called WP Carey, ticker symbol WPC. This is a net lease REIT, just like Essential Properties Realty Trust, Agri Realty, Realty Income, and others, but it has mostly missed out on the recent rally, and as a result, it has become far cheaper, relatively speaking. I'll put a table on the screen comparing its valuation to that of Essential Properties Realty Trust, which has been our largest net lease position in recent years, and you'll see that the difference is very significant. We think that this is an opportunity, and for this reason, we've recently bought more shares of it for our retirement portfolio at High Yield Landlord. We don't think that this massive outperformance is due to fundamental reasons. In fact, we think that WP Carey is in many ways better positioned than ever right now. Rather, we think that its recent outperformance is because the company's recent transformation led to a dividend cut, and this continues to hurt its market sentiment. As a reminder, earlier this year, WP Carey decided to spin off most of its office properties into a separate REIT called Net Lease Office Properties, I think is its name, in order to refocus on primarily industrial properties, deleveraging its balance sheet, and also lowering its payout ratio. The thought here is that this should allow them to accelerate their long-term growth prospects, also while lowering risks, and this should eventually be rewarding with a higher valuation multiple. But where this went wrong is that WP Carey was mostly owned by dividend-oriented investors, and they did not take kindly to the dividend cut. They felt betrayed by the management, which had so far consistently grown its dividend for 20+ years in a row. They lost trust in them, sold their shares, and this continues to hurt the market sentiment to this day. But I think that this is just temporary. In fact, the WP Carey situation today reminds me a lot of Agri Realty back in 2011. Back then, it was facing some tenant issues. It forced it to cut its dividend. This then depressed its market sentiment, and it was one of the cheapest net lease REITs, despite owning some strong assets for the most part. But it then rebuilt from a lower base, and as it fixed issues and returned to growth, it eventually became the single most rewarding net lease REIT in the following decade, easily outperforming its peers like Realty Income and most other REITs. I think that WP Carey finds itself in a similar situation today. Its market sentiment took a big hit to the dividend cut, and the market has low expectations for the company going forward. But in reality, WP Carey is now better positioned with mostly industrial assets that enjoy long leases with CPI-based escalators, and the REIT retains a significant portion of its cash flow to organically grow its portfolio and deleverage its balance sheet. The market has priced WP Carey for no growth, but as it proves it's wrong and returns to growth in the coming years, I would expect those dividend-oriented investors to eventually get replaced by total return-oriented investors like us, and this will then lead to a strong recovery in its market sentiment and its valuation multiple. Recently, we had the chance to interview the management team of WP Carey for a REIT newsletter, High Yield Landlord. If you want to access the full transcript of the interview, you can join us for a 2-week free trial. First link in the description. But here's an interesting segment that I want to highlight to you. Here's what they said. Closing that valuation gap comes down to execution. We've now completed the office spin-off and repositioned ourselves as a predominantly industrial and warehouse REIT, so we are in a much better place to demonstrate consistent AFFO growth. With a stronger portfolio mix and clear growth strategy, we believe the market will reward us as we execute our strategy. The next few years will be about meeting and exceeding expectations, driving acquisition volumes, and showing that we can deliver low double-digit total returns between our dividend and our growth. It's going to take time, but we are confident that as we execute, we'll see that valuation gap narrow. Many investors right now don't trust WP Carey's management because of the recent actions that they took, but I think that investors should give them the benefit of the doubt, because outside of the recent hiccup, WP Carey has historically executed really well and achieved one of the best track records in the entire REIT sector. Right now, they arguably own the best portfolio in the entire history, and yet the market has priced it at one of its lowest multiples in its history due to the dividend cut, which we think will soon be forgotten. In that sense, we think that WP Carey is today the Agri Realty of 2011. Expectations are really low, and its market sentiment can only improve from here as they return to growth. It will of course take some time for perceptions to change, but eventually WP Carey could enjoy up to 50% upside potential as it catches up to its close peers. And while you wait, you're earning a 6.4% dividend yield, and the company keeps creating value for you. Not a bad risk to reward coming from an investment grade rated REIT with a blue chip reputation. Hey, before I go into the second REIT, can you please do me a huge favor and click the like button if you enjoy this type of research? It helps me a lot to keep on growing. Thanks so much in advance. So the second REIT I'm going to discuss is called Sila Realty Trust, ticker symbol SILA. Sila is a brand new REIT listing, and just like WP Carey, it focuses on net lease properties, but instead of targeting warehouses, it's targeting mostly net lease healthcare properties such as medical office buildings. Right now, the company is offered at 11 times FFO and a 6.2% dividend yield, which would be reasonable if the company was facing stagnating cash flow, but this isn't the case here. On the contrary, expect Sila to enjoy some of the fastest growth prospects of any REIT in the coming years. Firstly, its recession-resistant properties enjoy 2% annual rent escalations, and its tenants are responsible for all property expenses, including even the maintenance of its properties. Secondly, the REIT retains a significant portion of its cash flow, about 30%, to keep acquiring additional properties. And then thirdly, and perhaps most importantly, the company is under-leveraged today. It only has a 20% LTV, and this will allow it to significantly expand its portfolio in the coming years. We think that it could expand its portfolio by about 40%, and its leverage will still be very reasonable. And given that it's getting 8% cap rates on new acquisitions, but only paying about 5% on its debt, this would result in very large spreads over its cost of capital, expanding its cash flow in the process. Combining all of this together, we think that the REIT has a path to growing its cash flow by 6 to 8% annually going forward, and such rapidly growing REITs typically trade at closer to 20 times FFO, but you can buy Sila today at just half of that. Therefore, we think it's reasonable to expect about 30 to 50% upside in the coming years as more investors become familiar with the company. As I mentioned earlier, this is still a brand new listing, so many investors don't even know about it, but as it becomes more popular, I think that we'll see its valuation multiple expand very significantly, especially as it starts producing these strong results and showing growth to investors. While you wait, you're earning a 6.2% dividend yield that's well covered as well. I think that these two REITs are great examples of what we like to target at high-yield landlord. They are essentially high-quality REITs with great assets, low leverage, strong management teams, but they're still heavily discounted because they're going through some temporary issues, but we think that those are just temporary issues that can be resolved over time. In the case of WP Carey, their market sentiment took a hit when they cut their dividend, but we think that as they will return to growth, the market will reward it with a higher valuation multiple. And then in the case of Sila, we think that because the company today isn't growing very fast yet, the market has priced it as it has at just 11 times FFO, but as it now expands its leverage and start producing faster growth rates, we think that the market will also reward it with a higher valuation multiple. These are great examples of what we like to target at high-yield landlord because they offer a high yield, but also upside potential from repricing as they reach a higher valuation multiple. But if you want to access my full portfolio, which includes 20 other similar opportunities, you can join us at High-Yield Landlord for a 2-week free trial. You'll be the first link in the description of this video. Once more, I will greatly appreciate if you click the like button, subscribe to the channel, helps me a lot to keep on growing. Thanks so much and see you at my next one. Bye-bye.